Hi, everyone. Welcome to this masterclass on rent versus own. I'm very excited to be here with an expert on mortgage financing, Josh Flores. And I brought him in order to explain the benefits of actually going and purchasing a home. There's a lot of people out there that I have encountered that don't really understand what are the benefits of owning, why you should own, and the major obstacles. I don't have a down payment, I don't have the credit score, or I had too much debt that I need to pay off, first. And obviously not understanding the benefits of owning versus renting. That's what we're going to focus on, because you need to see that the numbers that makes sense to you for you to realize how renting, although it might seem, cheaper for now, in the long run, it's just money that is not growing for you. So welcome, Josh. Why don't you give us a little bit of an introduction about yourself, and let's just get right into the topic.
Sure. So I'm Josh Flores. I humbly accept your expert description. Hopefully, I can live up to that. I'm with Supreme Lending. I have worked with Supreme for about 17 years. I've been in the business for almost 22 now. So had this conversation a ton, right, with a lot of different borrowers. I'm renting now. I want to own. What are the barriers? My credit. There's a little bit of it's just a little bit daunting sometimes, right? Intimidating, I guess would be the better word. Maybe they've heard about it, or yeah, and sometimes the information they've heard from a friend or a friend of a friend or a family member, their situation might have been very different, right? For the better or the worse. And so, no, we have these conversations all the time, and it's very clear that owning is better than renting in terms of from a financial standpoint, right? And that's one of the things that you have me on here is to kind of talk about that. I'm going to show you a little bit of a chart where we put some information in. It kind of shows you that time frame. And just like having your piece of America is kind of what we talked about, right? This is my spot. I get to plant roots here. I get to, start a family here. My kids might go to school here. There's so many different advantages to it. So that's what we're here to talk about.
Fantastic. Yeah, there is so many people in America everywhere, renting, but especially in Texas, here in Austin, with the sudden growth of the city, there are apartment complexes going up, everywhere, offering, really nice, facilities for a monthly payment that seems like it's a bargain, but in the long run, you still have to pay electricity and to pay for they charge you sometimes for this valet and other things that suddenly, instead of paying $1,800 rent, at the end of the day, you're paying $2,400 maybe, or $2,300. So I think understanding what it really means to rent versus own, unless you have to rent just because you're staying in Austin for just a year, obviously it doesn't make sense, because as you have said to me in the past, buying is for the long run. This is not for flippers. This is for the long run, for people who want to establish their roots, make smart financial decisions for the rest of their lives, and they really start, renting. I mean, they really, sorry, they really need to start looking into buying a home. So let's go first, before we get into the finances. Let's talk about the major obstacles that people think that why they cannot buy a home, and
Mhm.
let's um, help them understand how that might not be the case. So let's talk about the
Right.
three major things, which is I don't have a down payment, I don't have enough good credit score to get a loan, um, and I have too much debt that I cannot buy a home. So let's debunk those myths.
Yeah, sure. And I mean, if you want to start with the first one you said there, I don't have a down payment, right? Um, in everywhere, really, across the entire country. I know we live here in Texas, right? But in even more than counties around Central Texas, North Texas, South Texas, doesn't really matter. There's down payment assistance for folks like that everywhere. And so if the obstacle is, I don't think I have enough money to buy a house, that is something that you can get around. Now, I would tell you, just as a good bit of advice, of course, we want you to try to save up a little bit of money, right? That's always a good thing, just for moving in. And, anytime you're moving, whether you're moving from one rental to another, you'd still want to have a little bit of cash in the bank, right? But if you're thinking, oh man, I need to have 20% down, or I need to have 10% down, 10% of a very large number, right? You might not have that, but we don't need that. We just, usually I'd say, if you got a little bit, let's talk about it. Let's see, what we can make happen. Let's see what programs you qualify for. And if we can kind of fill that need, then we can get you in, right? And then from there, now you're off and running and you can make money, and now your house is making money for you. And so when you talk about debts and even credit card debts and things of that nature, one of the things I talk about is, gosh, your house is an investment, right? It's a performing, earning investment. And so I can't tell you how many equity transactions we've done, right? You refinance and pull equity out of your house, and that could be to send a kid to college, to start a business, to pay off other debt, right? You can now tap into that equity down the road because you've now made so much money on that house. So it's just, between you and I, I can't say it enough that it is absolutely the right financial, move for you to make. But it's just about kind of getting over some of those, perceived roadblocks. So, so that was the first one. And then I think, what was your second one? The
Yeah,
credit,
the credit score. A lot of people is like, oh, I have a really bad credit score. What is a bad credit score that, okay, yeah, that's bad. You cannot get a loan.
Well, so in general, I would tell you 580 or better is really what you want to stay above. There are certain options for those that even have below 580, right? But they do get less appealing, right? Like higher interest rates and things of that nature. Every 20 points above 580, so 600, 620, 640, 660, that's a lot of how most of these guys will work in terms of like what now opens it up to you. So as an example, with down payment assistance, 620, 640 is generally where all those programs unlock. So they're not going to go super low on 580, but we do have programs that do that. But once you get a little bit more, you get better incentives to buy, right? A little bit lower interest rates, a little bit lower closing costs, things of that nature, right? So now, it's funny, right after this Zoom call, I've got another call with somebody that's exactly what we're talking about. She wants to buy a house. We put a plan together for her about 6 weeks ago, and we're having another phone call to follow up and see where we are, right? Have you done this, this, and this? Do we need to update the score? Let's see where you stand. And if she's ready, great, perfect. Here's a pre-approval letter. Go house hunting at that point. Credit is something that is very malleable, right? It's very dynamic. Like, in other words, whether you have good credit, bad credit, or anything in between, your scores are always moving around depending on what's going on with your credit, when you've made payments, what your balances on credit cards are, all of that, right? And so the beauty of it with credit is, a lot of people think, I've got bad credit, I'm always going to have bad credit, it's never going to change, right? It does take a little bit of a mentality switch, right? Like it matters to make your payments on time. It matters to keep balances lower on credit cards. Now, it might not be something you can snap your fingers and do overnight, but if you kind of change your mentality on it, and more specifically, if we can paint that picture for you and say, if you do this, this, and this over the next 90 days, right? This is how much your score will increase. And we can do projections like that. We can actually run simulators that will tell us how much your credit will go up if you do XYZ, right? And so then that, that feeling of being trapped inside bad credit for the rest of your life all of a sudden kind of goes away, because you see, oh, I can do that. I can put this much extra towards paying my credit card down, or I can get rid of this collection, or whatever it happens to be. And we can help you with negotiating. We can refer you to credit repair companies. There's quite a bit you can do. And I guess the biggest thing I want to always tell people is, if your credit is the number one objection or thing that you see blocking you from getting there, that credit is absolutely something you can change. How long it will take kind of depend on what's going on. But if it's just some late payments, some high credit card balances, stuff like that, it's really not that complicated. If there's foreclosures and tax liens and bankruptcies and whatever, those get more major derogatory things. But even in that case, there is a plan to get out of it. It just might take a little bit longer. And, but we set a plan in place, we make it happen, and boom, we do it. I mean, homeownership is over a decade, right? Decades at this point. So even if it took you a year to get there, it's going to be worth it, right? It's going to change that trajectory of your finance, of your wealth, of all of that. And so that's the key. That's what we're trying to make happen. So
Hey, before we go into the next one, I know how does that work? Because I've been getting some information just pop up in front of my social media about using your rent to improve your credit score. Is that
yeah, so
true? And how does that work?
Uh, kind of, yes. So Experian has something called Experian Boost. I don't know if you've ever heard of that before, but you can put like so as an example, like your electric bill, your gas bill, your water bill, none of that actually reports to credit. That's not something that goes on credit, but if you use Experian Boost, you can actually report those payments to credit. So what it's doing is it's just giving you more positively reporting credit, right? So like some people, the problem with it's like this downward spiral. If you have bad credit, no one wants to give you credit. Right? So
Right.
no one wants to give you a credit card. No one wants to give you a car loan. Nobody wants to do anything. And if they do, it's really high interest rates. And so the key is you have to start somewhere. So a lot of times it might be Experian Boost using that feature. It also might be, hey, can I get added onto a parent's credit card that is doing well, right? They are making their payments on time, and you can be kind of like a cosigner of that, right? Authorized user is what they call that. Anything to kind of get your score moving in the right direction. Once we get there, you can release off of those credit cards and you're fine. And now you're off and running, because the key is to get you just above that mark. And all of a sudden everything and every creditor now wants to be your friend and offer you a bunch of credit, right?
Yeah.
But you'll be smart at that point. You'll know what you're doing and you won't run up a balance, and you'll understand the best way to utilize credit cards at that point. So that's all stuff we talk about when that's the issue. So
Okay. How about the debt that somebody might have? How much at one point, what ratio is like, okay, you really need to start paying this off? Or when they think, what is too much?
yeah, so I think what you're referring to is what mortgage guys call a debt to income ratio, right?
Yeah,
Like
I
when
think
we
so.
compare your debt to your income. So just a quick, for those who don't know, we kind of break down income and debt to a monthly number. So if you make $60,000 a year, that's $5,000 a month, right? So we break it down to a monthly number. We break your debt payments down to a monthly number. We divide your monthly debt by your monthly income, and it gives that ratio. In general, just as a rule of thumb, 50% or lower is kind of what we're looking for. There are loan products that will go to 65 at sometimes, depending on the product. So, but if you're keeping it in your head, think of 60%, and it's of your gross income. So using that same example, $5,000 a month, right? My salary is $60,000 a year. Let's say that. We're not taking your take-home pay. We're taking your gross before taxes.
Mhm.
So if your income is 5,000, you can have debts equal to at least 2,500, right? Because that would be 50% of 5,000. That's the debt ratio you're looking to stay underneath if possible. And so in that case, you want to make sure your house payment, your car payment, your credit card or whatever, all come in to something underneath that $2,500 number in that particular scenario. So
Okay,
yeah.
fantastic. All right, so the best way, obviously, to evaluate your capacity to go start looking for a home, obviously, is talking to a professional like you, not just thinking that I don't have the credit, I don't have the money, I have too much debt, correct?
So, if you get sick and you go to Dr. Google, you've convinced yourself you're dying within 30 minutes, right? if you want to buy a house and you're trying to understand, what mortgages look like, there's so much clickbait out there. You're going to think you can go buy a $5 million house in 30 minutes, right? So it kind of works the opposite, right? It's advertising, it's marketing, it's clickbait. And so give us a call. Yes, let us take a look. Let us pull a soft pull of your credit just so we can see it, right? It's not even inquiry on your credit if that's even something you're worried about. And then we can tell you, and we can give you more honest, real advice. Here's where you are. Here's where you stand. Here's comparing your budget. I mean, I think we talked about this in a previous video, but so I won't go too deep into it. But getting pre-approved for a mortgage, one, doesn't mean you're going to buy anything. So that's the first thing you should know. That doesn't necessarily mean you're moving forward. There's no commitment to it or any of that. But it's not just understanding what I can buy. It's understanding what I want to buy, right? What fits inside my budget. I mean, I like going out to eat. I like taking a vacation every once in a while, right? Whatever it is you're into, whatever your budget is, right? We want to make sure that that house fits inside of that budget. And it's not you make your mortgage payment and then curse Josh's name every month because I stuck you in a house that you can't barely afford, right? So, but I mean, we even go deeper. We go into what are you doing for work? Is there a growth path there? Like somebody who's in certain industries, like you work for Apple or Dell or one of these companies, any of these tech companies, right? You typically have little 5% year over year raises. And that's if you stay in your same position. Now, if you get promoted to a new position, then that's where you jump, right? So sometimes there's some sense in stretching a little bit to get the house that you really want because finances will get easier year over year, right? Sometimes there's not, right? You have an older person that's on a fixed income, something like that. We're not stretching in that case. We're trying to actually go the other direction, make sure it's nice and comfortable for them. They might have increasing Social Security or something like that. But again, it's a more in-depth process, right? And that's really what I want to impress upon people that are watching this video is like, don't just go to Google. Google, all they want to do is sell you something. And that is not in your best interest. We want to educate you on it and then let you make that decision. That's kind of the key. So.
Yeah, absolutely. Education and really understanding from a real person, not, as you said, Google is just amazing. Google
Yeah.
advertising. So, okay, so having said that, let's dive deep now into what people don't know, they need to know about the realities of renting versus owning.
Well, so, I mean, we talk about a few things with renting versus owning, right? I mean, I think we're going to talk about the financial side of it, and it's going to be very obvious that you'll make more money owning, right? Especially in this area where a lot of people are moving to, a lot of job opportunity, a lot of growth, right? Growth fuels demand, demand fuels home prices. So we'll talk a little bit about that. But there's a lot to do with owning a house, and it's something that guys and girls in my industry, especially in my branch, the people that I talk to and train and whatnot, I always like to remind people, like, it's not a client, it's not a borrower, it's a family, right? It's buying a house is a very big milestone in almost everybody's lives, right? Like if it's not, hey, maybe you got a very charmed life where you go do things that are even more fantastic than buying your first house. Good for you, right? But for 99% of us, we buy our first house, it's a big deal, right? It's planting roots. It's thinking about our family. It's a big milestone, just emotionally and personally, right? And it's like, so I think if you rent, it just you never feel that success. And I think celebrating successes, kind of breeds more success in your life. And that's kind of something that I talk about with my kids, right? But I also believe in personally. And so it's a big deal. It's a big deal. It's a big deal also with stability in your life, right? You're not just moving around all the time. It kind of centers you. And again, you're planting roots in one spot, and this is my spot. And so I think it's such a emotional thing to buy your first house. I would even say it's an emotional thing to buy your first investment property if you get to that point, right? I already got my primary, and now I want to go buy another investment because you just, again, personally speaking, I've done these things in my life, and I am an avid, believer in the market as well, like your 401ks, your mutual funds, your all just regular market style investments. But man, living in this area and owning real estate has been a big part of financial success for a lot of people, myself included. It really does make a difference. And so when people say, oh, my rent's going up and now I got to move again because it's going to go too high, one, that's nobody loves moving, right? We never
Mhm.
really talk about moving in my side of the world because
And
that's
it's
not fun.
expensive. The
It's
movers and
expensive. It's no
everything could
fun.
be a couple of $1,000s that you could easily put it towards a down payment.
And you kind of have to do it, right? So with renting, you have to do it far more often than if you're owning, let's say that. And so that's just another, you know, pain point of renting, if you will, right? So yeah, I mean, to me, that's and then also we talked a little bit about that, like down the road, if you have equity, tapping into the equity, that's such a big deal, right? I mean, I've had clients that start businesses with money they pulled out of their house. I have clients that pay for their kids' college, by, hey, my senior's going and they picked a school that's out of state and I don't have enough money for that. What do I do? Right. Well, hey, we can pull $100,000 out of your house to, next month if you want to, and boom, it's done. Right. And it's offers a tax deduction while paying for the school, a lower fixed interest rate than what a student loan might be. It's just, there's so many advantages to having that investment. Not just the emotional piece of it, not just the milestone in your life, but also just the financial advantages of it. So
Mhm. Okay. And when it comes to people waiting because right now it's obviously interest rates. Is there a good time to go and buy a house when it comes to the fluctuations in the market or the situation political, we just went through elections, so when is a good idea to wait? When is not such a good idea to wait?
So I always I love a quote from my a buddy of mine started a landscaping company. And I was asking him, I said, hey man, what's the best tree to buy if I need to replace a tree? And he's like, it's the tree you planted 5 years ago. And I'm like, why is that? He's like, because it's grown. It looks like a tree, right? And so when it comes to a house, it's I use that same thought. It's the house you bought 5 years ago because it doesn't matter. Like around here, you'll buy a house and in 5 years, it will undoubtedly, even through any of these tumultuous times that we've seen, higher interest rates, lower interest rates, crazy markets, whatever, look at 5 year comparisons and you have always made money on that house, always made money on that house. And so now if you're flipping properties and you're one of those guys, different strategy. I don't think that applies to the most people that would be watching this video anyway, probably all. But uh, you know, there's strategy involved in any purchase scenario, right? So, if you reverse back to say 2021, when the market was absolutely insane, it was like, oh, that's great. Rates are 3% or whatever you were getting, but I'm overpaying for the house by $100,000. And people still in that time thought, yeah, but rates are low. So great. Now, first time buyers, really tough for them back then. Really tough because they're not selling a house where they're making a bunch of money on, right? They're only buying a house. So if you were selling a house and buying a house at that point, well, you could kind of use that stupid money you're making on the sell to buy the stupid investment, right? But you're even in that case, right? And now you were able to move up. And so a lot of people did that. So that's not necessarily a bad idea in that case. That's why then the strategy was, well, if I'm selling and buying, that's a good time. And I can lock in a super low interest rate that I'll probably never have to refinance. Some of those people would say they feel locked into their house now because they don't want to go off and sell their house because they kind of bought at the top of the market. They got the low interest rate, but they bought at the top of the market. Market kind of came down a little bit. Now it's back up. It's going again, but it's tougher for them to go from a 3% to say 6% or whatever mortgage.
Mhm.
Now, for your first time home buyers now that same scenario, call it a $400,000 house, right? In 2021, you had to write an offer for 500 just to win. So you spend $100,000 on it. Today, you get the $400,000 house for 380, 385. And that seller likely is going to give you thousands of dollars to help you buy your interest rate down, right? So rates are high, but that's the strategy. Now we lean on the negotiations with the seller, buy your interest rate down. Locked one yesterday, 5.99%.
So
That's not a bad
explain
rate.
that a little bit how that works, because I think that is a huge fear that, oh no, I'm gonna wait until interest rates come down to 5%. But you can actually get a 5% now. How does that work?
So it's just buying interest rates down, and you can do it in a few different ways. We talked a little bit about this in a previous video too. So there's different kinds of buy downs. So again, when we talk strategy, that's such a big part of how you successfully and purchase and get a mortgage in this time frame. I think a lot has to do with if the seller is willing to negotiate, right? The seller is already giving you a good price on the house. But then if you want to say, there's some people that say, well, I want to negotiate on the price. I don't need any closing costs. I don't need any seller concessions. I'm fine with the rate. I'm fine with the payment. Okay, great. Then all your effort is just focused on bringing that price down, which isn't a bad strategy if that works for you. Most people don't want the higher interest rate. So if they say, well, I already know I'm getting a good deal on the house, so I'm gonna use my negotiating power to get 10,000, 15,000. I mean, like, I know that feels and sounds like a giant number if you've never actually bought a house before, but that is something we see every single day. Every single day. I see that. And if you have, say, $10,000 or $15,000 to buy an interest rate down, you can use that to supplement your payment and put all of that savings in a short period, like in a, say, a 2 or 3 year window where it moves your payment down and you use all that $15,000 for that. Or you can do it as a permanent buy down where it doesn't move the payment as much, but it does it forever, right? It never changes. There's refinancing strategies in the future. So if the market does come down, we can come in, refinance it, move the rate down, don't pay a single dollar in lender fees. We do that for free. So again, these are things that happen today. We didn't do no lender fee close or refinances when rates were 3%. That's not something that was out there. Now we do, right? Sellers weren't offering seller concessions to help with rate buy downs back then. Now they are, right? So it's finding the strategy that works for you. That's the key. And so again, we get into pre-approvals and all that, and you say, well, I really like these houses at this price point. Okay, but you don't like the payment. So that price point is fine, but all your negotiating power needs to be in your rate, right? Because that's what's going to bring your payment down where it's manageable for you and it fits inside your budget. So those are the kind of things that we need to talk about. So don't let it just be a, oh, no, I'm out. I can't do it. Don't let that be, because there are big numbers in real estate that can move that needle back and forth depending on what you want to do. And let me say this, if you had $15,000 in closing costs that you could use to a rate buy down versus reducing the sales price by 15,000, the payment is dramatically lower with a buy down, dramatically lower than would be just by $15,000 in real estate. Is, I mean, these loans are 30-year fixed rate loan. I mean, $15,000 doesn't change your payment all that much. $15,000 for a rate buy down, it can be triple, quadruple difference in how much it saves you per month. So.
Okay. So when I understand that once you a bank looks at you as a buyer, they will approve you for certain amount,
That's
correct?
right. Yeah. So I kind of call it like an umbrella. Usually I'll say, hey, this is kind of the top. This is what we can
Right,
approve you for. Anything underneath that, you're going to be fine.
right.
Most people don't want to be at the very tippy top of what they can afford. So, but they understand it.
But look at Austin, the
Yeah.
prices of Austin. Let's say that you have, a family that they want to live in certain area just because, close to family, the schools, whatever. And they are, right there that, the prices of the houses are right there where the maximum, maybe a little bit above of what they can get approved for.
Right.
So that little thin line, how will you help, that only a drop in interest rate or a
Yeah.
drop in house price, or, so as a lender, how would you help somebody to actually get that house when there's really, could be just a matter of a couple $100 a month in mortgage payment, or, your numbers.
I do. Yeah. And so there's several different strategies there, but let's just, the first one we talk about a little bit is, doing that buy down, because remember we talked about debt to income ratio, right?
Yeah.
Breaking down debt to a monthly number, income to a monthly number. Well, debt includes the house payment. So if we do buy downs and bring the interest rate down, the payment on the mortgage goes down. Therefore, the debt ratio goes down as well. Other times there are things like, hey, you have this little student loan that's got this really high payment, but it's only $3,000. So instead of putting 10% down, why don't you do 5, take that 5% that you were going to put into your house and pay this consumer debt off, the credit card, the finish off a car payment, or whatever the case is, right? And we can manipulate the debt ratio that way. And it actually makes more of a difference in your monthly cash flow by getting rid of that. Credit card debt is the worst. It really is.
Yeah,
I mean, you could have perfect credit. You could have 800 credit scores and your interest rate is still 18, 20% on that guy. It's ridiculous. It is absolutely a scam. And that's something that we talk about. I mean, even if you have lower credit, getting those balances down and then using the credit cards the correct way, which would be like spending, paying them off every month, spending, paying them off. You get all the points, you get all the benefits for that, right? The free stuff that they offer, but you don't pay them a dime of interest, right? They still get their money. Every time you swipe your credit card, all those
right,
vendors, they have to pay them. So credit cards are perfectly fine if you're using it all month long. Even if you pay it off, they're happy about that, because they make all their money. They're going to make their money either way. That's kind of the little downward spiral of those guys. And if they get you with a balance, it's like that minimum payment is not paying off the balance, and they do
right.
that on purpose. And there's been many conversations, lawsuits, all kinds of stuff with credit cards. But long story short, that's the problem. So, but when you say, how do we fix that problem? It might be, hey, let's reallocate some money from here to here, right? I've
Mhm.
seen people, deep in some credit card stuff, and they say, well, I got a 401k at work. You take a 401k loan. You don't pay anything for it. Get rid of that and then just put it right back into your 401k, but you're not paying any interest on it at that point. You're not paying that fee. You're just putting it right back in, right? So there's so many different strategies because, again, with mortgages and real estate, it's bigger numbers, right? And we can get the seller to pay all your closing costs. It saves you money out of pocket, and then you can redirect that money to something that's really genuinely helping your monthly cash flow. So that's usually the easiest thing to do. We can flip loan products, some that will have higher debt ratio tolerances, some that have lower. Um, there's lots of different things. That kind of comes with experience in the business, is like that little puzzle, like figure out best, down payment assistance or not, or this, or first time home buyer credit, or, it used to be, easier. That's going to show my age, but used to be like, you just conventional loan or FHA loan or no VA loan, whatever. It was easy. Now it's like, you're looking at, minimum 15 different products every single person you look at, right? To figure out what works best.
Mhm.
And you might be surprised, like, oh, I thought that loan wasn't what I wanted. Like, well, here's why it is, and here's why it makes a difference, And so, and if we can get that to work, right, in that situation, hopefully we get it inside their budget where we're not putting them in a precarious financial position, and they can get the house they want that's by their family, that maybe is a little bit outside of what they were looking at, but it works. But
Mhm.
the last thing I'll say is, it's about making sure they understand it, right? Like, the client understands the strategy, the client understands the payment, the client understands the down payment, and we make that decision together. And as long as they're okay with it, I'm okay with it. As long as I can do it and offer it to them. And again, they're not cursing my name afterwards.
Right.
So,
And at the end of the day, everybody has to pay where they live. Nobody lives for free, you know, unless you're still living with your parents. But the moment that you're paying a rent out of your paycheck, obviously you have a job, you're making payments. It's just about educating yourself how we can transform that money that is going to rent into money that is building you equity, correct?
yeah,
So,
I mean, that's the key. I mean, that is the key, is we're trying to, I mean, you're going to write that check every month for wherever you're living, right? Whether it's rent or own, or it doesn't really matter. You got to pay for the roof over your head no matter what. And they'll kick you out if you don't make the payment, right?
sure.
Rent or
Yeah.
own. And so that's the biggest, I think the biggest fear of, like, you feel like you have more flexibility when you're renting, right? I can move anywhere I want. I can do whatever I want. It's like, but generally you're not trying to move where you rent every year, right? Like, I mean, I
Right.
would say at the very least, or most, every 2 years, right? But even in a 2-year window, you're going to make more on an own than you would on a rent. In a 1-year window, no. If it's just 1 year, like you said, don't buy. if you're going to be moving in a year, I don't recommend buying, right? If you know you're going to move. But if you're going to be there 2 or more years, absolutely. Heck, I mean, you can move out and then rent the place out if you can, hold on to it as a rental.
As a
I
rental,
mean,
yeah.
there's,
What you want to do is live in um downtown after all. It's like, okay, I try living in the suburbs because that's where I could buy a house, but I really want to live close to downtown. Rent out your house. Rent it out is still building equity, right?
I had in my head when I was younger, I bought my first house and I thought about the whole renting thing, but it wasn't real in my head necessarily. It was just something I thought about. I still own that house today. I bought it, gosh, probably almost 20 years ago, right? I still own it today, and it's paid off, and it's a rental, and it's in Austin, so you can imagine it's pretty good amount you get in rent every month, right? And so,
Yeah.
um, it that's the thing. You have to kind of think long-term strategy. Like this is an investment, just like any other long-term investment. And again, I always compare it to like 401ks and market style investments and whatnot. It's like, we talk about inflation, right? Inflation, there's even a now I think we're down to 2 point whatever percent, depending on whichever metric you look at, but it did spike for a little bit, right? But property ownership, owning homes is kind of, your defense against inflation because it's this giant asset that's growing at say 4 or 5% per year, right? So inflation is say 2 or 3%. Now you have a large asset, right? But it's not 5% of a small number. It's 5% of a big number, right? So if
Yeah.
your house is worth 300, 400, 500, or more $1,000, it's like that's 5% of $500,000 that you're making on that, which is significant. And that's year over year.
Yeah.
So it's such a big
25,
difference.
25, yeah, 25,000 a
It's
year.
a huge difference. It's a huge difference. And so you're not going to do that with rent. You're just not.
Nope.
You just write your check, you pay your fee, and they allow you to stay there another month.
Hmm.
It's really as simple as that. And some
Simple as
people
that.
think, oh, well, I don't want to, I don't want to mow a yard. It's like, well, you can pay somebody to mow your yard if you want to with that 25,000 you made it.
Nowadays, now they're like maintenance-free homes. They just put gravel everywhere here in Texas to save water anyway. That
Yeah.
was, so that's the thing. It's like you don't like maintenance, now the new housing that I see going up, it's almost maintenance free.
Hmm.
It's everything,
Yeah.
or you pay a homeowners association fee. You live like in a condo, even owning a condo. Okay, you don't like owning a house, own a condo. Condo is just like an apartment, but you own it
Right.
and you
Yeah.
can
Right.
do anything,
The only difference in a condo is you don't own the land underneath it typically, right? You own the structure, but not the land. And so it does still appreciate in the same way a single family residence does, but you
right.
don't take care of the land, right? So yeah, sure,
Mhm.
you don't own it, but it, you know, it's a shared ownership. Let's say that you don't own it individually.
Right.
So you do still make money on it. And you also, in a lot of cases, don't even have to maintain it. Yeah. So,
Mhm. Yeah,
um,
I own a condo for many years and I loved it because, I didn't have to do anything.
right. Yeah.
Beautiful. They kept the common areas beautiful. Everything was just beautiful. I just enjoyed it and just like, okay, here's the money that I normally would pay the gardener to mow my lawn and somebody to come and maintain, pressure wash the house. And still, I was going to pay that with a house and have to worry about scheduling all those things. Now it's like,
Mhm.
so I did like, you know, condo ownership. I did that for many years. So and it
Yeah.
worked
Yeah.
fine.
I mean,
Sold the
it,
place, made some money.
there's different levels of it, right? There's different levels of ownership, different types of ownership. I mean,
Mhm.
it's funny when I've done some property tours where you see these like giant houses, right? This eight million dollar house, and in my head, I think, man, this is a lot to take care of. Like,
Yeah,
you need a full-time person that lives there to take care of this property, and it's like, but as you get smaller and whatever, there's so many different examples of, upkeep when it comes to a house, right? Also, if you're buying like a house that's maybe newer or a house that's recently remodeled or something like that, it's like, everything's good in here, right? I'm not going to do anything to this house for quite a while. And a lot of the materials now, like they really, gosh, a lot of this, I don't know if you know, but like like flooring and different, like even exterior
Right.
hardy planks and different things that they use are just better quality materials that quite simply last longer, right? I mean,
Yeah.
the only reason you replace them is because you want a different look, right? Like my
Right. But you don't replace exactly. Just
floor
it's
was perfectly fine. I
out-
just wanted it to look
outdated.
different.
Yeah, but remember, when they had the siding made out of wood, you had to treat it for termites and you had to repaint it. I mean, maintain the wood.
Yeah,
And then go to the point in which, remodel the house, take out the wood siding and put the new type of artificial siding. So it's pretty good.
yeah,
So
yeah.
anyway, we can talk about all this all day. Let's go into numbers. I think that you have something you want to share with us, right? To
I
start to
do.
visualize.
Let me pull this up real quick here. Can you see that on your screen there?
It's coming up. Yeah, it's right
Okay.
there.
So this is just a little quick example, and this is a program we use when comparing things and kind of sharing information with clients or whatever. So if someone really wanted to dig into the numbers of the difference of, owning versus renting, this is a good one to look at. So I'm using a scenario of a $400,000 house. We can edit that, we can move it around, but that's kind of something, I don't know, in the middle. Might be a little bit high in some cases, but also low in some cases. So we're comparing rental, right? If you're renting, what the difference in renting would be. So if you're paying between two different people, you have a 2 bedroom or however many, if you have family, you have a 2 bedroom or 3 bedroom apartment. I'm using 2568 as the number. This is a loan amount of 360,000. So this is just doing 10% down. I'm just trying to put anything in there, and we can adjust these with particular clients so we could show different things. But what it shows is kind of a year over year comparison. So remember when we talked about if you're going to be moving in a year, don't buy. Here's why, right? So in these calculations, we have closing costs, right? You probably pay about $8,000 in closing costs. So there's not enough time in a year to recoup that difference, right? So in that first year, sure, you're making appreciation, right? Historical average is 4.18%. So we're using that. That's specific to I used an Austin zip code, right? Different areas you can see higher. Gosh, in 2021, we saw 20-30% appreciation at times, right? But that was kind of an
Yeah.
anomaly. So this is more normal, right? I think conservative, but normal. So in that first year, so as an example, if I move this down to say a 2-year look, you've now appreciated in the course of 2 years by $34,000, right? In terms of amortization gain, amortization is meaning like when you make a payment on a mortgage, part of it goes to principal, part of it goes to interest, right? So this is just the principal portion of your payment over those 2 years. Amortization is not very much in the first couple years of a mortgage because your balance is really high when it starts. Now, as you go through the years, it gets more significant. But the biggest one is always going to be the appreciation. That's always going to be the one, right? You have a tax benefit. Tax benefit is not as big of a deal anymore because they raised the standard deduction when you're doing your personal taxes. So it's a little bit of money, but it's not much. And this is just a 2-year look, right? But it's also taking out, again, $8,000 to buy. It's also taking out $17,000 and assuming like if you did sell it after 2 years, right? There's fees to sell a house. And so it takes that out. And in 2 years, you were net positive $3,670, right? Doesn't sound like a lot, but now if we push that to 5 years, it makes a pretty big difference. Now we're at 61,000 in 5 years, right? Rent only went up at that point in five
Yeah.
years, right? And so it shows kind of a month or like a cash flow difference over that time is about 26,000 because your rent is increasing. It's just you don't make any money. You only lose money on rent. That's all you do because it only goes up. It never goes down. I mean, I should say, I guess maybe it does go down in some cases, but it's pretty rare, right?
Yeah.
They would probably just keep it the same if they're not going to raise it on you, right?
Yeah, during
Um,
COVID, rents went pretty high, and like a house was charging 3,000, a 3 bedroom, 2 bedroom, and I did some research on that. And now you're getting $1,800 for the same house.
yeah,
So it
and
was
keep in
crazy
mind,
during
a,
COVID.
a lot of times we're saying a rent of say 2,500. That's an apartment, right? That's a 2 bedroom, whatever apartment. You don't have a yard. You don't have any of that stuff. We're comparing this to a house, which is very different. You have much bigger spot, yard, neighborhood, schooling is likely better. I mean, there's so many other advantages that don't just play into the financial advantage, right? But that's what this chart is kind of meant to show. So in most cases, I would say people are going to hold their house for 5 to 7 years. I haven't actually looked up. There's probably an updated version of that. I don't know if it's extended in time or if we're still in that realm or whatever. But 7 years now, you're at 111,000, right? Now, using the example I was talking about earlier, say 7 years. Okay, now we do want to move, right? We want to go somewhere else. Maybe you sell and you cash out and you take your 111,000 and you walk away. Or maybe you hold it and now you want to rent it out, right? Now, every other house is much more expensive all around there. Rents have definitely gone up. So maybe you hold on to it and rent it. And if you hold it, then you're just getting more and more equity in that house, right? The house, again, I bought whatever that was 19 years ago. It's probably somewhere in the realm of about 3 or 4 times what I paid for it initially at this point, depending on when we're talking about, but at least three and maybe as much as four at one point. So it's crazy. It's crazy to think about. I remember between my second and third house, I held my second house for about 2.5 years. We had a new baby in there, and anyway, things changed in my family, and we realized
Yeah.
we need to move a little closer out to the rest of our family, and because that was going to help with the kids and all the stuff, right? When I sold it, I did the math. I lived there for free. It paid every single payment plus some, right? Like I literally lived there for free for 2.5 years if you take all the money I made on that house. So you take all the payments, put it into that. It was like, that's crazy, right? It's kind of insane. And so that's the kind of thing that happens in an area like this, where you have population growth, you have employment growth, you have demand, which again drives that appreciation number up. And that's why you see that 4.18 average. And I would say that's pretty conservative, right? If we move that number up, those numbers look even better. Um, this is also assuming you stay at a 6.5% interest rate the whole time. Likely that's not the case. Likely we come in and refinance it to something lower in the next coming years, right? So this is kind of, and I say all this so this is a conservative look at it.
Right.
I think the numbers could look even better, if we wanted to push that way. But I would prefer to stay on the conservative side. That way, I don't know. I like being in worst case scenario a lot of times when I talk to people. That's a better way to look at things, in my opinion. More, you're not looking as much risk. So.
So at this hypothetical house,
Mhm.
we talk about a rent of 2668. What would be
Yeah,
hypothetical monthly?
2568 is what I had in here.
Right.
And the way I look at it is 4%, if you can see that screen, 2568, renter's insurance. People generally have like a little policy to cover all their stuff, which is like 39 bucks a month. And I just have annual rent increase of 4%, which is, I don't know. Some years are more than that, some years are less than that, but that's kind of what we're using in this
Mhm.
particular example. So.
Okay. And with what would be your expected house monthly payment, principal, interest, and taxes, typically I know there's so many
Um,
variations, but
So this one, let's see, do I have that in here? I don't know if that shows on here. I'm trying to see if it shows it. Sorry, it might not.
mm,
I don't think it does. I mean, it's calculating it in the background, but I don't think it
I see that.
shows it for you here. That's the same thing. Yeah, I don't think it does. It's not going to show you the whole thing. Sorry, I know there's probably a way to show that, but I'm not pulling it up immediately here. Monthly buying, renting. Oh, okay. So principal buying, saying 420. Yeah. Sorry. Estimated. Okay. So
Oh,
here,
there it is.
3233. So
Principal,
it's more,
interest,
right?
property tax.
It's assuming your payment's going to be higher than what your rent is, but it's calculating that, right? So it's saying, yes, you're paying more per month, but you're also making more per month. And
Yeah,
so,
and I think that's why a lot of people like they stay renting. It's like owning is so expensive. My rent is 2,500. If I own a house now, it's 3,200. That's $700 difference.
Right.
But what they don't see is the appreciation
Well,
of
the
the house.
appreciation, and again, I'll talk about it again. If we do see rates come back down, which we expect them to, I expect them to be down already, to be honest with you, especially with the fact that inflation is down. But yeah, we were in an election year. It's been a little bit of a wild ride here, so we're looking forward to things kind of calming down a little bit, and then seeing the true progression of where things are going. But people know the Fed rate has started coming down. It was only going up from about 2021 April. Or sorry, 2020, was that 2022? Yeah, 2022 April is when it was, where it started going up and up and up. And then now more recently at the end of this year, we had our first cut a couple months ago. We had our second cut. Our first cut was 50 basis points, which is 0.5%, if you will. And then our second cut was last week was 0.25%. So the key there is that they have changed course, right? You raise the interest rate to curb inflation. They're winning that battle. They're now changing course, pulling it back down. By pulling it back down, it kind of opens up the economy again, allows businesses to borrow money, people, to hire more employees, to expand their business and whatnot. They want to be careful with that because they don't want to create inflation, right? You don't want to just shove the interest rates down all of a sudden, businesses go wide open, people have more money, and then we have that same inflation problem, right? So
Correct. You gotta do it, drip it,
little
yeah,
bit
that's
at a
exactly
time.
what happened when all those checks from the Fed, incentive checks and lower
Mhm.
interest rates. That's why the houses went out so expensive. Now people that now that it's over 5 years later and they want to sell and they want to sell their house, they're going to lose money. I mean, they're
Yeah.
underwater. They bought at
Well,
100 and it's selling for 450.
it's been a very unique time the last 4 years with COVID.
Yeah.
And so basically we're recovering from all of that is the thing. And so if you look at charts that go from like say 2010 till now, and you look at that trend line, right when you hit 2020, you see this kind of nuts stuff.
Mm-hmm.
If you look at the overall trends, they're there. It's the same trend we've always been on. We just had this weird anomaly for 2, 3 years, right? Because of COVID. And so it's been a process. And that kind of drip that you're talking about is what the Fed calls a soft landing. That's what they're trying to do. They're kind of trying to create a soft landing. The reason we had this crazy anomaly is they had to all of a sudden move rates down significantly to help during COVID. They were doing that on purpose, right? To help people not lose their houses, to refinance and
Right.
get all their bills super low. And that was a big deal in helping. We didn't want another crash of the economy. Hindsight, maybe give out less money, right? But when you're in the middle of it, nobody knew. Nobody knew.
Yeah, you just
There
do
were
the
so
best
many.
that you can with the information that you have. So
Yeah.
what happens to this chart if right now you put in yeah, hypothetically 6.9% interest? 6.5. So if we can buy down 1 point, the way you say it, what would that look like?
So you're saying, well, are you saying move it down to like 5.5?
Right. If you can buy down, because you can buy down for like 1 year, right?
Yeah,
Until
you kind of
waiting to interest.
see that change, right? So
Mm.
over the course now it goes up to over 200,000, right? Because you're spending less monthly.
Mm-hmm.
Now I assume you'll probably buy it down to that maybe after the course of a year. And there's no way in this particular um, generator to say, hey, what if I do it at this point, right? It doesn't have that option, but that's key. And that's again why I like to put it at the higher number to say kind of worst case, right? Like
Worst
that's where you're
case,
going to be,
yeah.
assuming you never refinance.
Mhm,
Um, it's highly likely you do, though. It's
mhm.
very likely that you do. Everybody's kind of chomping at the bit to bring those numbers down, to open up more than just mortgages, right? It's commercial stuff. It's all kinds of stuff when the Fed brings that rate down, it basically kind of re-stimulates the economy, where everybody has more confidence to invest in their business, grow their business, and they're not all kind of pulling back and being conservative like they have been more recently. But yeah, I mean, our economy really has recovered significantly in comparison to global economies. So we're doing well. It doesn't feel
Oh,
like
yeah.
it
Yeah,
because
yeah, we're
it's
spoiled,
just
when
it's
we
been
have
rough.
everything here. We just want it cheap, people that as you said, that there were kids when the rates were at 3%,
Yeah,
they
yeah,
expect, they want rates now that they're in the buying market. But the
yeah.
truth is that our parents, grandparents, they used to finance houses at 9%, 12%.
Yeah, well, and perspective is everything, right?
Right.
So there's perspective on rates, and they just seem like, oh, they're high. Well, they were in the eights, and now we're in the sixes. I mean, that's definitely lower than where we topped out at anyway. Um, but I think it all plays into affordability and where you want to live and that kind of thing. Like there are very affordable areas to live. It might not be
Mhm.
in might not be in downtown Austin. It is not in downtown Austin.
Definitely not. And if
So
you ask me, I think it's just a very good way to throw away your money, in taxes and, okay, your house, it is, appreciating. But you can be, house poor, or you can just drive until you buy something affordable that it gives you a nice lifestyle, right?
yeah, yeah. I
You
mean, exactly. And again, I know a primary residence, right, is that it's this is my home, right? You don't put as much financial businessy thought into it as you would if you were buying like a rental property, as an example. Um, but you should, right? It is very, very, very much an investment, and likely the largest investment you've ever made in your entire life when you buy a house, right? And so it matters, it matters. And you want to think of these things in, you want to think through them, right? You want to think forward, have forward thinking when next 5 years, 7 years, 10 years. You really want to think through that concept. It's not, again, it's not property flipping. It's different, so um, it's just yeah, to me, if you want to truly kind of build wealth, you can't do it. It's very difficult to do it without real estate. It's just extremely difficult to do it. Again, it's an offsetting to inflation, right? Inflation goes up, your house goes up. So it offsets that inflation just right in itself, plus some, right? If the annual inflation rate is say 2.5%, but your house is appreciating at 4 point whatever 1% or 5% or whatever it happens to be, you're also curbing that, right? You're combating that. So it's yeah, it's a big part. It's a very big part. And then as you get into retirement, which I know we're really going deep here, but eventually you want to have your house paid off, right? And you might
right.
sell the expensive house, the bigger house that if you had kids and all the stuff, now I don't need a 5 bedroom house anymore, right? I need a 2 or 3 bedroom house because it's just, maybe you and your significant other or whatever, right? Maybe you move outside of town. You don't want to be in the hustle and bustle anymore, but now you take this massive win and you move to something smaller and you pay cash for it at that point. You hold on to the
Mhm.
rest of the cash and maybe invest it and let it pay you out over time. It's like, when you talk about long-term planning, it's a big part of it. So,
Mhm. Absolutely. You mind killing this
oh, yeah.
the share just like we can see our big faces. There we go.
There you are.
So all right, so that was amazing information. Thank you so much, Josh. So what would be the major takeaways for somebody that is renting and is not so sure about, can I buy a house? Is it the right move? What would be your top takeaways from this masterclass?
If it's something you want to do it. That's really the biggest thing. If it's something that you want, if it's a goal of yours in life to own real estate, start the process, right? Look into it at the very least. It's not something, again, you're not committing to it. You're forced into buying a house by any stretch, but I think the point in which you can define it as a real possibility, as a real option, I think it changes the game, right? It's like it really changes your mentality, uh, and it gets you over the hump of, the fear or the hesitation or whatever it happens to be. It's like you can kind of check that off your list, right? Like it's like a list of things when you want to buy a house. Getting pre-approved is one of the early check marks that you have to check off that list. And so check it off, right? If it's something you want to do, and it doesn't really that's what our jobs are, right? If you have a hesitant, oh, my credit's this, or I don't have the assets for that, or, whatever the case is, that's our job. Let us worry about that. So if it's something you want to do, come talk to us and we'll show you how to do it. And if it's something you can do tomorrow, great. If it's something you can do in 6 months, also okay. A year, also okay. Right? Like we have people that we talk to over the course of many years that come back and, hey, I want to do this, or hey, I want to do that. Well, you can't do it now, but you can do it later. It's like if it's something you want to do and you want to commit to doing, and it's a goal in your life, I don't understand what's stopping people sometimes. It's like,
Right.
um, make it happen, right? Like that's the only way, and you will not regret it. I mean, if you follow a strategy with home ownership, it will undoubtedly be financially beneficial for you. I mean, it really will. And so I can't stress enough. When I have teenagers at home too, and they see what I do, and I talk about what I do, and it's like these are, we talk about credit and how to, stuff like that with them, because unfortunately schools don't teach a lot about some of this stuff. They're starting to, some of them, but in our days they didn't, right? And so that's what's
Not at
led to
all.
some people making mistakes on credit, making mistakes they didn't know. They just quite literally didn't know, right? And then it feels like this endless pit that they can't get out of. It's like, let professionals advise you and then make your decision. Don't make your decision based off of bad information.
Mhm.
So
Yeah. And
that's
even
really
if
my
it
biggest
is,
message.
yeah, I think even if it is not your top desire to be a homeowner for you to live in there, but I think one of the major needs as human beings is a sense of security.
Mhm.
Financial security, there's a lot of uncertainty in this world. Um, and well, when you have a way to get a hold of money without having to borrow from somebody else, that gives you a lot of sense of security. And your house is your biggest piece of equity that you can go and pull money out without having to like move out. You can
Right.
still live there. It's not like, well, I'm gonna have to sell one of the cars so I can, feed my family. And now you don't have a car, right? So really consider um just thinking about it. And the next step from here obviously is we'll talk to a professional to get your start looking at your finances and what is a possibility, and you know what kind of buying power do you have, and getting ready that you are, don't want to do it right now. That doesn't mean that you do not want to do it later or you change your mind. So knowing where you stand right now, it would give you the upper hand. Knowing exactly what is just like, your health. You know that right now, you have what do you call, some pre-existing, inherited disease like diabetes, for example. Well, you start right now starting to eat a little bit healthier so you don't develop diabetes. So knowing that you have that tendency, it will help you in the future. So right now, your financial health and ability to purchase something, you just don't know. So that is what we have to say here as professionals. We really are grateful that you came to the end of this long, seminar. I know there was just a lot to take in. So the next thing to do is just reach out. There is a link below this video that you fill out that form and give us just a little bit of information. It will get to us and then we'll reach out to you. And there's just a lot going on. Just click on the link below to follow the process, and we will see you on the other side. So have a great day, guys. Thank you for being here with us. Thank you, Josh, for being so awesome and explaining in so much detail. And can't wait
Absolutely.
to see you in the next class.
All right. All right. Very good. Looking forward to working with anybody who is ready to go.
All right. Thank you, guys. Bye.